And we are live, Energy Week show, Energy Week Can't Talk podcast. Ryan Ray here alongside two doctors to start off the show, Dr. Ellen Wald and Dr. Dean Foreman. Dr. Wald, how have you been?
Things are pretty good here. Yeah,
Well,
had to
I just got out of the
early
swamp.
Sunday morning OPEC meeting, but
Yeah, I saw some tweets about that. I was in the swamp in DC, so I escaped barely, but someone asked me how deep I got, and I said probably too deep, probably too deep. But that's for another time. But a man who manages to avoid all of that is the one, the only Dr. Dean Foreman himself. Dr. Foreman, how are you doing today?
I'm doing great. Good to see you. Thanks.
Good to see you as well. Let's get into it. You sent over your monthly statistical report that is coming out tomorrow.
It is,
Okay,
yes.
so it's not out yet. Come out tomorrow. Start where we always start. Give me some things that may surprise you or took you by notice from this report.
Well, I think the thing is it's validating of what we've seen the last few months. So demand continued to increase. And here are 20.6 million barrels per day of domestic petroleum demand for the U.S. in June. These are the latest data for June, estimates from API here. And it really is on the gasoline side, urban activity, driving activity, cities reopening. And there is some tourism, I'm sure, coming back with a resumption of activity just as vaccination rates have increased. But that's a good sign that things are normalizing, and it's pretty broad-based.
Well, let me bring in some anecdotal evidence, which we love on this podcast, which is so right for the election, I toured the country and I flew all over and was in a lot of airports, and there was no one out and about. This time, going to DC and back, they were offering travel vouchers for people to get off of the bird and to sit and to wait for another plane. The security lines, they weren't bad, but there was actually people in them. I mean, it didn't feel like 2019, but it felt kind of normal. So tell us about jet fuel demand.
Well, it's up. This is the strongest month we've seen for it so far. So we'll see how it heads. But right now, if I locate the number for it specifically, it's a fourth straight increase for jet fuel. We were up to almost 1.5 million barrels per day, which is great. That's an 8% increase from May, which you'd expect some seasonal increase anyway. And roughly it's still a little over a fifth and below where it was in 2019. So there's a ways to go. The international travel activity really hasn't picked up. So at this point in time, it's really a supply limitation, right? As you experience, there are only so many flights going, and it's going to take this continued push or pull from demand to get more flights open.
One of the interesting things that I noticed when I was looking at the MSR was that we're seeing, a pretty good resumption, like you mentioned, in urban activity, driving gasoline demand up. But we're also seeing strong demand for refining and petrochemicals. And also, you mentioned that distillate is holding steady. So how are we seeing a shift in I remember before when gasoline demand was low, we saw that there was a shift into more petrochemicals. Are we seeing these petrochemical levels holding, and is that going to translate into overall more demand?
It's two great things to highlight, and let's take them separately. First, on the petrochemical side, the fact that as we have the Delta variant and other things, a lot of the needs for the shift to online retailing with packaging, but then medical plastics and all that goes with that, we're continuing to see some growth there. It's not the booming growth that it was late last year, early this year, but it's continuing, and it's still double-digit gains above where that category was in 2019. Now, when we start looking at distillates, and this is the foundation of API's economic indicator, our distillate economic indicator. So diesel fuel with the switch toward online retailing, it's leveled off over the last several months. I mean, it's not like the total demand for distillates is growing rapidly. It's sort of peaked. But on a year-over-year basis, compared to where we were a year ago, it's doing fantastically well. So in the way the indicator is constructed to correlate with industrial production growth on a year-over-year basis, it's got the highest level reading that we've ever seen for any month back to 2007. So this is a really strong, valid leading economic indicator of industrial production and broader economic activity. And it consistent with other economic indicators that are out there. It's just booming. So this is a really strong sign for at least the industrial side of the economy continuing to go well.
Talk to me about storage. I mean, like I get on Twitter every day and there's people Twitter fist fighting over storage. What does the API's take or data reflect on the storage?
So think of it this way. The refiners, as Alan noted, they've been picking up. They're refining more and more. So the product inventories, they're there. They're ready to be used, and they're planning forward through this summer driving season. So that's been in pretty good shape. But quietly behind the scenes, the crude oil inventories have been getting edged down. So lower and lower they go. And as you can imagine, if that's an indication that the supply for crude oil is just not keeping up with the demand growth for crude oil, both domestically and the pull for exports. What that means is we're importing more of what we need, and the supply situation then ends up being your leading indicator for where the inventories are likely to head here. So just reading the tea leaves on it, I think we have an issue. I mean, when we look out over the next year, and we look at the amount of demand growth that the EIA, the U.S. Energy Information Administration, expects, coupled with where we are in terms of drilling activity, which is picked up, but is still roughly half where it was in 2019. So despite some really strong productivity at the well level, to get some true volumetric growth on the supply side, to really pick up markedly and not be range bound, it's going to take a step change forward in drilling activity that we haven't just seen yet. So roughly, if we're taking, and the comparison I use from our quarterly outlook is that we have a record amount of demand growth going on with the recovery in the economy, coupled with a record low right now in terms of investment in drilling activity. So it really is problematic in the sense that for this phase of the recovery, we're going to need to look forward, look for more supply, and give or take, looking out the window today at prices versus last week for prices, if there's going to be some sentiment battles back and forth for the market. It won't necessarily be a straight line, but it is concerning that we need more drilling activity, more investment to really meet the needs over the next year.
I'd love to talk about these inventories, kind of unpack what's going on a little bit more, because we said that inventories are at their lowest that they've been since January 2020. But, and correct me if I'm wrong, inventories were still pretty high in January 2020 because, we had just had so much production. So are we really getting to a point where, there's not enough supply, or are we finally just beginning to chip away at the, we've basically used up all the excess that we built up over 2020, and are we finally going to chip away at the excess that we'd had from before that?
No, it's a great question. And the way we do our charts, right? We map it versus a 5-year band. And if we look at this last month for June, the inventories really are toward the bottom of that 5-year band. So, relative to where they've been with the summer driving season compared to the last 5 years, they're relatively low here. So keep in mind that the upper end of that band was really expanded by virtue of what happened with COVID-19, so that it accentuates the extent to which it's toward the bottom. That being said, just the fact that the drilling activity is so low compared to where it was in 2019, it is a concern that we do need more to be able to replenish these supplies.
Well, I remember late in 20 something, we had you on the podcast. It was 2019, I think it was, and there was talk about the ducks. We have enough ducks for 6 months of production. I can't. If this report references ducks, I didn't see it, so you might not have the information on here, or maybe I just looked over it. But any insight on how the ducks are weighing into this equation? Are the ducks going away? Are they building up? Have they leveled off? Was that thesis from the EIA? I think it was who predicted it turned out to be true, that we do have 6 months worth of production that we could put on for the ducks. Any thoughts there on that?
The last time I've looked at EIA's drilling productivity report and the data that they break out on their estimates for wells that are drilled but uncompleted, they've come down. They're not at the high levels that they were. I don't know the exact number off the top of my head, but having come down, the thing is we're still really looking now compared to where we were for drilling activity as a pulse going forward. And we also have some basin-specific issues that will pop up. So the Permian Basin, where you are there in Texas, you're really looking at things continuing to go well. There's ample pipeline capacity, the activity level, slack capacity, and services, it's all there. But some other basins that are producing have some pipeline constraints or potential pipeline constraints, and the ability economically to ramp right back up. If we're looking at the Denver-Julesburg, Niobrara Basin, if we're looking at the Bakken, there are some things that would make it, producers or operators a little more hesitant to invest at this point. So that's not to criticize these basins or say one's better than the other. I think within a range, the estimates from BTU Analytics would say that they can all be competitive at recent prices. But the activity levels actually picking up, we're looking for probably the Permian Basin to be our leading indicator of where that might go.
Let's talk about exports, because we're again, yet again, we are a net importer of petroleum products, and yet our exports are on the rise. So maybe you can unpack that for us a little.
So we started saying domestic demand recovers, domestic supply hasn't, and that's created the need to import more. At the same time, this last month, we saw a pretty big pickup in our exports of crude oil, which means that it really is a pull internationally, saying that the international economy and international oil demand has remained relatively resilient here. And it's showed up in the relative prices too, our domestic WTI versus international Brent crude oil prices, where frankly, they had pulled to some really narrow levels, like less than $1 per barrel at one point. And with that, you would expect that what we're seeing then with this pull for international is that the domestic prices have been pulled up toward import parity at that point. And it's not going to be long for oil or for natural gas, where I think we should be concerned that the exports will be blamed for actually lifting domestic prices. Now, that blame, especially on the gas side, is not altogether fair in the sense that that international demand begets its own supply, its own domestic projects and production and drilling activity and jobs and all the economic growth that goes with that. But on the crude oil side, until it can catch up, where we're in a quandary of seeing the industry really grapple with the structural changes of the last year and trying to get some firm footing, be able to have the confidence to plan forward, expecting higher prices, expecting higher demand, and expecting the economic recovery to stick. Until that happens, right now, we really are starting to import more, and the mix of that ends up affecting the prices here at home.
Inflation. Do we need to be concerned about the impact of inflation on our crude oil exports or on gasoline? I mean, how can we expect inflation to impact energy?
I'm so glad you asked that, because this really is, as I'm writing an article about this MSR that'll come out tomorrow, the consumer household impacts, in particular for gasoline prices, are one of the things I really want to highlight. Because if we have a nationwide average of $3.15 or $3.16 per gallon for conventional gasoline, if this keeps going, you can, if, for example, based on historical relationships, if you went up to $100 oil instead of $70 oil, you're adding another 70 or 80 cents per gallon at that point. And the affordability issues, Janet Yellen came out really last week on behalf of the Federal Reserve Bank and made a statement about inflation, looking, and every economist has a pet economic indicator. She looked at used car prices and said, well, these record used car prices are starting to recede, and this could be a leading indicator that as supply chain concerns are resolved, that some of these prices will start to recede and price inflation may not be so structural. Well, I would say for oil and gas markets, maybe the Federal Reserve needs to look a little harder, because what's happened here domestically, these are structural changes where we could see drilling activity pick back up. The official estimates from EIA and other sources are not alarming, because they assume that, and have assumed continually over recent months, that drilling activity would be stronger than it has been. But on the international side, where we have a record low also for investment and drilling, we've seen a lot of the longer lead projects, the ones that take time to develop, having been canceled altogether or at least delayed. So if you don't have those projects ready to bring supply, about the only thing left you have is OPEC spare capacity. And this ends up being, where do prices go? We can't predict it. API doesn't. But it is a concern that the market looks rather tight when we go into next year, unless and until the economy pulls off the trajectory that it's currently been on.
Any sorry, any insight on? I don't know if we've had much hurricane activity. It doesn't feel like we've had much. Is that impacting these numbers one way or another? Because I know we've talked about the impact of hurricanes with some of these reports historically, but it's been kind of quiet, it seems.
Knock on wood. I mean, let's hope that it stays the course and that we don't see that kind of major disruption. There's nothing in the data that's done that as of yet. The last major data disruptions that we saw were back in February with the winter storms, and it could happen again. And if it does, that'll affect supply again as well as demand. And in the way we've seen it play out the last couple of years, and having relocated from Florida, and Ellen, you're still there. You know, I went through 4 of the last 5 years having evacuated, so I understand this.
Well, I guess I'm just thinking about, we kind of talk about, well, it's the highest in June or the highest in July or the highest in August. And then you factor in that some of those months, though, we have Harvey or whatever that kind of skews those numbers. So it's just I was thinking about as you're talking, we haven't had a major Gulf hurricane that I can think of this year. If we have, at least in Texas, that's disrupt refineries or anything. So yeah, I guess the freeze would be the last thing. We had the Pemex pipeline, the vortex to hell open up, a few weeks ago in the ocean, but that's about it seems like.
One of the things I was wondering that we could talk about is natural gas, because I think that there's definitely some growing concern that natural gas prices are going to be higher in the winter, and this is going to affect people, particularly in colder climates. So maybe you could talk a little bit about what's been going on there and where you think this is headed.
Another great point, and I think with the way drilling activity has been, and really no market pickup in natural gas drilling activity, despite the fact that we've seen spot prices as high as $3.75 per million BTU in the last week or so. With that and a futures curve above $3 per million BTU, you would think, based on the estimates from BTU Analytics and other sources, that it would be economic all day just to dedicated dry gas drilling. And I think really the main pulse of what we're seeing, because the rig activity has picked up a bit in Ohio and Pennsylvania and other places, it's the associated gas with oil production that's continued to be under a lot of pressure. So unless oil makes a turn, that's helping, or rather that's hampering this recovery in the natural gas supply that we need. And hence, when we look at EIA's weekly gas report, we start to see that the injection rate for storage is below where it typically has been over the last 5 years. It's not at troubling levels by any means at this point, but it's something to watch.
Okay, Dr. Foreman, anything else that you wanted to mention in the report that we didn't cover? And then obviously, I think you said you have another post coming out tomorrow as well. Maybe recap that again and where people can find that.
So we will post this on API's Energy Tomorrow website. And for those who aren't familiar, at api.org in the upper right-hand corner of the website, there's a chief economist section, and all the blogs can be linked directly through there. And this is really taking apart what the affordability issues are, where by EIA's estimates, crude oil remains the top input cost in making gasoline. And as we've seen the changes play out and we look at the supply-demand situation, this is where all of this coming together ends up being our concern for saying, how do we get ahead of this to make sure that people are aware that we need domestic supply, we need the infrastructure to deliver it, because all of these fuels are remaining essential as the economy continues to recover.
Okay, very good. And we will see you next month. Thanks for working with us this week as I was traveling. And so
Absolutely.
A day late. Folks, we will link to API's website in the show notes, so you can check that out. Be sure to download the report. This show will come out today's Tuesday, right? Yeah, come out either late Tuesday or early Wednesday. The report itself comes out Thursday, so be sure to bookmark it for that. Dr. Foreman, we will talk to you next month.
Absolutely. Great seeing you both. Thank you.
You too, bud.
See you later.
All right, Dr. Wall, let's see here. Couple things to get to. First, we'll go to our favorite, the New York Times. I think there's a Twitter stream somewhere. I was thinking about this morning when I was flying home. There's got to be a Twitter stream that goes back like 100 years and breaks down what the New York Times was covering 100 years ago today. I would actually be curious to see, what the New York Times was writing about 100 years ago today. a random aside. This, but anyways,
Yeah.
okay. From the New York Times, building solar farms may not build the middle class. Sorry. So are you here to tell me, Dr. Wall, that the Green New Deal might not be green for those in the middle class? Is that what you're saying?
Yeah, exactly. It's interesting because um, we've if you look at apparently this is kind of like a bit of a deep dive into what actually goes into constructing a solar farm,
Mhm.
and apparently they pay quite poorly, and so that's the issue. And that the so-called green jobs. So remember way back when we had, all the pipe fitters and such got fired from the
Mhm. Mhm.
Keystone XL pipeline. They can just go do, install solar farms. Apparently, gosh, who would have thought the jobs don't just translate one to one? Um, it's interesting. I'm not really sure that any of this is like I don't like the obsession with like middle class. This is,
Right.
because we don't really know. I mean, it's kind of, they say good paying. Well, what does that actually mean? So, it's interesting. So it says there's building a 2,000 acre solar farm in Michigan.
Mhm.
And says for workers used to the pay standards of traditional energy industries, this can be jarring. Building an electricity plant powered by fossil fuels usually requires hundreds of electricians, pipe fitters, millwrights, boiler makers who typically earn more than $100,000 a year in wages and benefits when they are unionized. But solar farms are often, guess what? Non-union
Right.
construction laborers who earn an hourly wage in the upper teens. So that's the issue. And so, I just, I think people need to realize that the jobs don't translate one to one, and these are different kinds of jobs. And who'd have thought, right?
Well, and the other thing is, and I don't know much about the building of solar farms. I've got a buddy who's a developer, and it takes, if I understand, I don't want to misquote him. I think he says it takes like 2 years just to get everything lined up to make sure that they can build a project. So there's no one being employed during that time other than him and the engineer or whatever it is that they on their little team, and then they build it. And so it's like pipeline construction. Pipeline construction, you have you have a team, and you have a mass influx of people building it, and then those people go away. And so unless you have those people perpetually working,
Yeah.
In a good economy, for pipelines, you do. But if you don't, then they just come work. So it's more of a seasonal job than it is like working at a nuclear plant where you're here for 60 years or whatever. And so there's
Exactly.
other thing. So and I don't know how many solar farms are being built or whatever, but I just know that it is, even if you said, hey, we're going to build 100 solar farms this year, however many long-term jobs that creates is a fraction of the total jobs it creates during the building phase.
Totally. And in fact, in the article, it says it's kind of interesting. So apparently there's a coal and gas powered plant in Michigan that's supposed to be shut down in 2023. And the plant has 130 maintenance and operation workers who are unionized, and their wages begin at $40 an hour plus benefits. Apparently, they are guaranteed jobs at the same wage within 60 miles. But the union says many will have to take less appealing jobs. And the utility company says that they don't have nearly enough renewable energy jobs to absorb all of these workers. So they're going to shut down the oil and gas plant. And these guys are guaranteed jobs, but the utility is like, we don't have jobs for that. We don't like renewable. There's isn't that, and that's. I think that's something that gets lost. There's this idea that operating a solar plant is the same as operating a wind farm is somehow the same as operating a nuclear plant or a gas plant, and it's not.
Yeah, and I don't know. Again, not a solar farm expert here, but you can't put them. There are spots you can put them, spots you can't. There's all kinds of things involved. And I don't know, he's told me a little bit about the criteria for what they're doing, but I think their criteria is you have to hook into the grid at a certain spot, if I understand correctly. So there's only so many of those spots that would work in. So but anyways, we can get someone to talk about all that, but it is kind of interesting when you begin to dig in there. Okay. European aircraft movements rising. they will be taxed. Wait, sorry, I added that on. That was my own deal. Not that's not from the story. That's coming soon.
Yeah.
But
they're rising now before they get taxed.
according to this, more aircraft flew between European airports yesterday. This was on the 19th. than any other day since the onset of the COVID-19 pandemic in March 2020. This kind of gets back to where we let off, or where I was saying earlier, which is it kind of feels when you go to the airport like, okay, it's not as busy as it was in 2019. That's been a long time ago, but if I walked into Reagan or a DFW, I wouldn't be like, there's a pandemic going on, something's weird. I'd be like, oh, okay, it's just a light day or whatever. So it seems like the Europeans are getting back that way too.
Yeah, for a long time we were talking about how, stuff was picking up in the US faster than it was picking up in Europe. And I thought this was a good way to kind of gauge what's actually going on in Europe. Because Europe, there's a lot, Europe has a much better developed train system than the US, and lots of people travel by train, but there are also a lot of, quick flights you can get on. There are all these like budget airlines in Europe. People would just take, to get places for holiday and such. So it says, so there were 23,000 flights yesterday compared with 36,000 on the same day in 2019. So not there yet, but it's the closest they've been. Which I thought was interesting. So it says that between January and May, flight numbers trailed pre-pandemic levels by 60%, and numbers only began to substantially lift in the last month. And it's moved up by 22 percentage points by yesterday. But I kind of wonder whether it can actually get any better given the kind of like chaos that you're seeing in Europe in terms of like who can go where and restrictions and this and that and what kind of restrictions and all this stuff. Plus, you've got these new taxes that they're putting on. And then it also says in here that there are some refinery outages that are causing tight jet fuel supplies. And so prices are going up. Are budget airlines really going to be able to offer anything when taxes are going up and the cost of jet fuel is going up? Are we looking at kind of a Europe that is just kind of permanently fewer flights?
Well, and we keep saying this over and over again. You have the large, long international flights that aren't there. But so I was traveling, so you probably caught this a little bit better than I did. But if I understand correctly, the Brits are saying that you're going to have a vaccine passport to go to bars and clubs coming in September.
I thought it was just clubs. Is it bars too?
Okay, yes, I saw kind of the headline. But okay, what does that mean for an American going to?
You can't even get in without like quarantining for 10 days because they don't accept.
Do I have to have a passport?
No one knows because these things they keep saying this and then like it doesn't come to fruition. Like now they're saying like people who've gotten vaccines not from the NHS like don't even count. So
but just think about it. Like right now, you can I want to go to London for Christmas or travel for the holiday. If you don't even know if you can access buildings. Same with France. Like you're going to see a stifle in international travel because you don't know what you can do. You can get there even if you're in quarantine. And so I think a lot of these rules, they got to figure out what the rules are going to be before you can. So it feels like each week we come on and you're like, okay, well maybe things is like no. We're not ready yet.
No, honestly, and I haven't felt worse about this. Like it's been getting better and better, and I feel like that's starting to turn around and get worse now.
Mm-hmm. Mm-hmm.
And I'm not sure that that's necessarily like indicated by the data, because like people are talking about it like it's so bad, like it was like last summer, and it's not. But there's. It's this lack of clarity in terms of the regulations that is going to just stifle all kinds of economic activity because no one's going to get on a plane and go somewhere if they don't know that they can actually like go anywhere once they get there. And they've got to clarify this stuff and stop changing it every 2 seconds. It's the same with regulations for business and all of that. Like you can't keep changing your mind every 2 seconds. Businesses are just going to throw up their hands and say we can't deal with this.
Speaking of which, hold on. Everyone should go read this. This is fantastic. It documents the war, for those listening, which is everybody, The War on Small Business by Carol Roth. Fantastic book. I finished it while I was gone, and I had to do most of it for the interview, but I finished it and document so much of what happened and how much it impacts small businesses during COVID. So be sure to check out her book. Okay. Emissions could hit a new record by 2023 without more spending on clean energy. I'm going to
I'd like
say,
to add that and say, and append to that and say, and even with more spending on clean
yes,
energy.
that's what I was say. Even with more spending.
Yeah.
I mean, I had someone the other day ask me about something about China and this, and I just, they were just more curious. And it's like, well, yes, China's going to do what they're going to do, and they're going to keep doing what they're going to do, and so is India or Pakistan or any of these countries. They're just going to do what they're going to do, and so we got to quit pretending like they're not. And it's weird that we kind of live in this world where everyone gets on for Americans about being America first, America centric, or not having a global view. This is where I get frustrated that we don't have a more global view. When you're talking about emissions and all this stuff, and it's like, yeah, well, if China alone puts out more than everyone else, and does it really matter? But no one else has any awareness. So
I mean, this is basically the head of the EIA, specifically Fatih Birol, coming out and saying, "You're not spending enough. You're not spending enough. We told you need to spend more on what we, think you should spend it on, and you're not spending enough, and you're subsidizing too much coal." And he says, without international finance institutions playing the role of a catalyst, the money will not go where it is needed. So he's basically saying, international finance institutions, stop funding things that are demonstrated that people need right now, and start funding these things that we tell you you'll need in order to achieve these climate goals. So like, if you're an international financial institution, okay, great, but like, what about all the people who need electricity?
right.
Like, we have, so what are, they're always going to find someone who's going to, finance their coal or whatever. Because I mean, remember when we talked about that book about the commodities traders? Like, these were people who were making sure that like Gaddafi had oil,
Yeah.
or like South, like, there's always going to be somebody out there who will make sure that people get what they need because there's money to be made in that.
The book literally starts with people flying to Libya. What didn't
Yeah.
trying to deliver oil to to the rebels and stuff. So yes,
Yeah.
yeah, exactly. No, it's infuriating. Okay, speaking of oil, we'll wrap it up here. Sorry for the short show, but I just got back, so haven't been following as closely as I should have been. OPEC. I started a slight kerfuffle on Twitter yesterday after we saw a pullback in the market. I don't know if you saw all that happened on my Twitter feed. There's a slight pullback, and I just made a tweet, just kind of having just phone with some people I know on Twitter, and it was people took it a little too seriously. Anyways, what happened with OPEC? Do we have resolution? I saw some tweets Sunday morning, but I didn't follow the whole thing. What's going on here?
Yeah. So OPEC reached an agreement, which is like extraordinarily complicated. Basically, they agreed that they're going to increase production by 400,000 barrels per day starting August. And so they do August, September, they're going to do 400,000 barrels a day through December. Then they agreed that like everybody, like 5 countries are going to change their baselines starting, I think, in April 2022. And that includes the UAE, which got almost as much baseline increase as they wanted, but also Russia and Saudi Arabia and Kuwait are also getting baseline increases. And then there's some other stuff that's really complicated. There was just a good Argus article that came out that was detailing it that I posted in my Twitter feed that I'm just going to see if I can pull up so we can go over it.
It was part one. If this 2.5 million barrel increase by the end of the year, is that what you're saying?
Yeah, I don't think it's 2.5. Okay, so OPEC is going to add. Okay, OPEC is going to add 3.3 million barrels a day of production to the market between this August and April 2022.
Okay. A lot of answers for me.
Yeah. Then there's so that's including like, I don't know, all sorts of other stuff. Then it says this will leave. Then they might also increase the monthly quota increase will increase in May to September 2022 if a 3-month pause is not used. So they can pause for 3 months if they think that like they
Mhm.
went too far,
Mm-hmm.
or they'll keep going and increase by another 432,000 barrels per day between May and September 2022 through this baseline increase mechanism. At least that is my understanding.
Yeah, so they're leaving just
So yeah, very
a little over 2
complicated.
million barrels of spare capacity off the market for now.
Yeah.
So
And
they can pick up if they need to.
and oil dropped 7%
Yeah.
on Monday.
So on the U.S. side of things, this is kind of not the news you want to hear, right? Because the OPEC saying that, hey, we're gonna make sure we try to put a lid on this thing, and we kept some more in our pocket to make sure we really put a lid on it if it gets out of control.
Yeah, I mean, it depends. If you're a consumer, you're going to see lower gasoline prices pretty soon. On the other hand, if you're a producer, I mean, prices are still high enough that you still make a profit, but it's not going as high as it was. I mean, Goldman Sachs did have to revise its outlook. They still think we're going to hit $80 oil in the fourth quarter, but they apparently have like revised it down somewhat. I don't know. I'm not sure. I honestly, like, I think that there are some weaknesses in the US in terms of gasoline demand. I know that like we saw a big increase in urban driving. You know, we talked about that with Dr. Foreman. But I honestly am kind of hesitant that that's going to continue come September because, you know, gasoline demand typically falls in the autumn months, and it's not entirely assured that people are getting back to the office. Like there's been this assumption everyone's going to go back to school, everyone's going back to the office come September. But Apple just came out and say, oh, we're pushing off till October. And you know that everyone follows where the tech companies go. So I think that that's really up in the air. I think that, I mean, I think some companies probably will go through with it, but it may not be as big a boost as people were thinking was going to happen.
Yep. And to your point earlier about you know what's going to happen as far as mask mandates. I know Los Angeles County, you know, went back under mask mandate Saturday night. I guess it was Sunday morning, something like that. So wanted to see what kind of trends. So we're not out of the woods on stuff like that. The Brits with their COVID whatever protocol, the French are protesting in the street. So we have a lot of COVID calls.
That's like happens all the time.
Yeah, they're well, whatever. Sure.
Yeah.
We have a lot. I'm just saying we have a lot of COVID protocol to get through to figure out where demand can pick back up at and where it just won't. So, okay. With that being said, Dr. Wald, thank you for working with my schedule. So, apologies, I had to go to DC for some meetings, but I am back now, and so there we go. Where will you be this week?
This week, tomorrow, I'm going to be on TD Ameritrade TV network, talking about the OPEC decision and the market fallout. And then I will be on investing.com with my weekly column on Thursday.
I actually thought of you was in DC. I walked by TD Ameritrade has an office or whatever with big windows. It looks like their studio. I don't think they have a studio there, but it looks like
it's
the one
in Chicago.
Yeah, they have one in Chicago. They have one in New York. It kind of looks like the one that I've seen you. I was like, oh, looks like what she does. Okay, I will be on the only podcast that Big Oren has endorsed publicly, which is Inside the War Room. So if Big Oren endorses it, you got to go watch it. Like, I mean, that's enough alone. So Inside the War Room this week. Dr. Wald, thank you again, and to the listeners, we'll be back next week.
Bye.